The big story this morning, the other big story this morning, which is India's current account deficit touched a 9-year high of 4.4% of GDP in the July, August, September quarter. This was mainly due to a sharp rise in the merchandise trade deficit in those months. Lata is here to give us more on that. Lata, over to you.
It's a tough unfair to ask me these jargonized questions after that very interesting chat on what's going to happen on New Year's Eve. But yeah, the dollar is more expensive. I mean, likely to be more expensive because of the numbers I'm going to tell you. The current account deficit has touched 4.4% of GDP. That's the difference between our imports and our exports, broadly, including services and other flows. At 4.4% of GDP, it's a tad dangerous because India has, for the last 30 years, worked with a Lakshman Rekha of 2.5 to 3%. We don't like it to go above 3%. Now, the problem is this is caused by a 30% rise in imports. Imports have done well, but that is only a 16% rise in, exports. So imports clearly are the problem. And if you thought crude imports is the problem, no. Non-oil imports have risen by 25% in the quarter. And therefore, that clearly is not only an oil issue. The things that have done well for the current account deficit are service exports, software, grown by 30%, and Indians living abroad and transferring money to India. That private transfer is also up 30%. So that's what's working positive. But still, there is this deficit, 36 billion. How do you fill it? That's the FDI, the portfolio flows and the FII flows. Their FDI flows are a good 2 billion lower than what it was last year. FPI flows were good, but external commercial borrowing, loans taken by Indian corporates abroad, was zero. So that, again, was not enough to fill the deficit. So we have a balance of payments deficit, which means we pulled out from the reserves to pay for it. The reserves fall was about $30 billion compared to a surplus, an addition of reserves in the year ago, same quarter. But let me end with some good news. After all, you all began with the New Year's cheer. So the good news is that the previous quarter, April, May, June quarter numbers have been revised lower. The deficit we were told earlier was 2.8%. It's brought down to 2.2%. That's because the calculated imports were not as bad as customs made it out to be last quarter. 191 billion has become 185 billion. So the trade deficit of last quarter, which was 68 billion, has become 63 billion. Nevertheless, if you count Q1 and Q2, it is still a current account deficit of 3.3% of GDP. Like I told you, it's over our Lakshman Rekha. However, the positive is economists think that H2 current account deficit could be a tad lower.
Okay, forget all that. Where are you partying tomorrow night, Lata?
That will remain a secret.
We're still waiting for your birthday party, by the way.
Yeah.
Hope you had a great one. Thanks a lot for joining in. Well, Vahishta is with us to tell us about the Momentumizer stock of the day. Vahishta, over to you.
Hi, Sonia. I'm going to